Fed trapped, rate cuts coming as inflation ignites, gold and silver alert. Ladies and gentlemen, welcome back to the desk. If you were watching the tape today, you witnessed a level of volatility that would make a seasoned floor trader sweat through his suit. We are not just talking about standard market noise. We are talking about a calculated, vicious assault on the price of silver that reeks of desperation from the bullion banks. Earlier in the trading session, we watched the white metal take an absolute nosedive, plunging violently below the $49 level, touching lows around $48.57. It was a textbook Friday slam, designed to break the psychological will of the retail investor going into the weekend. They want you scared, they want you selling, and they want you to believe that the bull run is over. But here is the reality that the mainstream financial media will not tell you. The smash failed. It failed spectacularly. What we witnessed after that initial plunge was one of the most significant intraday reversals I have seen in my 2 decades on Wall Street. Instead of capitulating, instead of folding like a cheap suit, the buyers stepped in with a vengeance. Silver clawed its way back, fighting tooth and nail to reclaim that critical $50 handle. As we sit here moments before the close, we are hovering right at the line, with the bid price teasing us just below the threshold. This is not just price action, this is a war for the very soul of the currency markets. The fact that they threw everything but the kitchen sink at this market to keep it under $50, and yet it is still knocking on the door, tells you everything you need to know about the underlying physical demand. The paper shorts are cornered and they are running out of ammunition. Let us zoom out and look at the broader carnage, because silver was not the only victim of this volatility today. We saw a massive liquidation event across the precious metals complex, with rhodium taking a nosedive that should set off alarm bells for anyone watching the industrial sector. Rhodium plunged nearly 2.5%, shedding almost $200 to sit at $8,180. When you see a specialized industrial metal like rhodium get clobbered, it is often the canary in the coal mine for industrial slowdowns. However, the resilience of the monetary metals, gold and silver, in the face of this selling pressure indicates that money is not fleeing the sector. It is merely rotating. The smart money is positioning itself for a currency crisis, not an industrial boom. Gold, the king of metals, also faced the heat today, dropping about $12 to trade around $4,066 an ounce. But let's put this into perspective. Despite the rampant manipulation and the algorithm-driven selling, gold never once threatened to break below the $4,000 psychological support level. It held the line. In a world where the S&P 500 is detached from reality and bond yields are erratic, gold holding above $4,000 is a testament to its role as the ultimate store of value. The bears tried to push it down, utilizing every trick in the book, but the bid support at these levels is concrete. This tells me that central banks and sovereign wealth funds are buying every dip, quietly accumulating while the retail public gets shaken out. Now we need to address the elephant in the room, which is the sudden and dramatic shift in the Federal Reserve's interest rate expectations. If you want to know why gold and silver staged such a massive turnaround late in the day, you have to look at the bond market. The probability of a rate cut at the December 10th meeting has skyrocketed. Yesterday, the odds were sitting at a tepid 39%. Today, they have exploded to nearly 70%. That is a sea change in sentiment in less than 24 hours. The market is effectively screaming that the Fed is trapped. They cannot keep rates higher for longer without breaking something fundamental in the banking system or the sovereign debt market. The pivot is not coming, the pivot is already priced in. Why does this matter for your portfolio? Because a rate cut in December is the green light for the next leg up in inflation. The Federal Reserve is signaling that they are willing to sacrifice the dollar to save the bond market. When you cut rates while inflation expectations are still sticky, and believe me, they are sticky, you are pouring gasoline on a smoldering fire. The algorithm traders saw that 69.5% probability and immediately stopped shorting the metals. They know the history. They know that when the Fed eases into a high inflation environment, real assets like gold and silver are the only lifeboats available. This drastic shift in odds is the catalyst that turned a potential bloodbath for silver into a consolidation day. Let's dig into the economic data that supposedly drove this sentiment, because the mainstream narrative is riddled with contradictions. We saw the University of Michigan consumer sentiment numbers come out, and on the surface, the headlines look positive. The reading came in at 51, slightly beating expectations of 50.5. The media is spinning this as the return of the resilient American consumer. But if you actually read the report, if you look under the hood, the engine is sputtering. Current personal finances and buying conditions for durable goods plunged more than 10%. Think about that for a second. People are feeling slightly better about the future only because they have resigned themselves to the misery of the present. The report explicitly states that consumers remain frustrated by the persistence of high prices and weakening incomes. This is the disconnect between Wall Street and Main Street. The stock market sees a resilient consumer, but the actual families sitting at their kitchen tables are deciding which bills to skip this month. The data shows that while long-term inflation expectations have softened slightly to 3.4%, short-term expectations remain elevated. The average American knows that prices are not coming down. They know that the cost of living is permanently higher. The slight tick down in inflation expectations is statistical noise. The reality is a steady erosion of purchasing power that is driving people toward hard assets. We also received PMI data today from S&P Global, and it paints a picture of an economy that is fracturing. The service sector is expanding, sure, but look at manufacturing. The manufacturing PMI fell to 51.9, down from October. But the devil is in the details. Manufacturers reported a worrying combination of slower new orders and a record rise in finished goods stocks. In the logistics and supply chain world, this is what we call the bullwhip effect in reverse. Companies are sitting on mountains of unsold inventory because demand is drying up. This accumulation of unsold goods is a recession signal flashing neon red. When factories stop producing because their warehouses are full, layoffs follow. Furthermore, despite the narrative of a robust labor market, the report highlighted that the rate of hiring is being constrained by worries over costs. And what is driving those costs? Tariffs and rising input prices. Both input costs and selling prices rose in November. This is the stagflationary nightmare scenario that the Federal Reserve fears more than anything else: a slowing economy combined with rising prices. The inflation hawks at the Fed are looking at this data and sweating bullets. They know that if they cut rates to stimulate the manufacturing sector, they risk reigniting the inflation bonfire. But if they don't cut, the manufacturing recession deepens. They are checkmated. Speaking of tariffs, we have to discuss the geopolitical landscape because it is intrinsically linked to the price of gold. The incoming Trump administration has signaled a potential pullback on tariffs for foodstuffs, which might alleviate some pressure on the consumer, but the broader tariff strategy remains a tax on the American public. There is no debate about this among serious economists. Tariffs are inflationary. If we enter a trade war environment, the cost of goods will rise, and the dollar's purchasing power will fall. The market is trying to price in these policy shifts, but the uncertainty is palpable. Gold thrives on uncertainty. When traders don't know what the trade policy will be in 3 months, they park their capital in the one asset that has no counterparty risk. Then we have the situation in Ukraine. A new 28-point peace plan has been floated, which appears to be more pro-Russia in its outlook. Whether the Ukrainians accept this is highly debatable, but the mere existence of a negotiation framework changes the risk calculus. Peace, ironically, can be a double-edged sword for the dollar. If the geopolitical fear premium evaporates, we might see a temporary dip in the safe haven demand for the greenback. However, any de-escalation that involves ceding territory or shifting alliances accelerates the multipolar world order where the US dollar is less relevant. The BRICS nations are watching this closely, and every misstep by the West strengthens the case for an alternative gold-backed settlement system. Now let's circle back to the price action on silver. The fact that we are closing the week fighting for $50 is technically significant. In technical analysis, previous resistance becomes support. We spent years trying to break through 30, then 40. Now $50 is the battleground. If we can turn $50 into a floor rather than a ceiling, the path to triple digits becomes purely mathematical. The volatility we saw today, the washouts, the stop-loss hunting, is characteristic of a market that is coiling for a massive breakout. The weak hands are being shaken out so the bullion banks can cover their shorts before the real move begins. It is also worth noting the dollar index, the DXY, which ticked up slightly today to sit around 100.16. Usually a stronger dollar puts pressure on metals. But today we saw gold and silver fight back even as the dollar held its ground. This decoupling is crucial. It means that gold is not just trading as an anti-dollar trade, it is trading as a sovereign asset class. Investors are buying gold not just because they hate the dollar, but because they fear the entire fiat currency regime. When gold rises alongside the dollar, it tells you that there is a systemic fear in the global markets that transcends simple currency pairs. I want to take a moment to discuss a personal observation that serves as a perfect metaphor for the times we are living in. I visited my local bank today, something I rarely do as I prefer to be your own central bank, and while I was there, I spotted a coin in the teller's tray. It was a proof Sacagawea dollar from 2004. It was shiny, it was golden, and it looked valuable. I asked to buy it and the teller handed it over for face value, $1. It was in pristine condition, likely cracked out of a proof set and spent by someone who didn't know what they had. But here is the kicker, despite its beautiful golden appearance, it is not gold. It is manganese brass. This coin is the perfect representation of the modern financial system. It looks like money. It feels like money. It has the color of gold. But at its core, it is base metal. It is an illusion. The person who spent that proof coin at the bank exchanged a collectible item for face value because they didn't understand value. They only understood price. We are living in a world where the vast majority of the population cannot distinguish between price and value. They chase the paper price of stocks or the nominal value of their home, while the real value of their labor and their savings is being debased by the printing press. The fact that this coin was sitting in a teller's tray, unappreciated, is exactly how the general public treats gold and silver today. They see it, they might think it looks nice, but they trade it for paper promises. They deposit their paycheck into a bank that pays them 0% interest, while inflation runs at 4 or 5%, effectively paying the bank to debase their wealth. You, the listeners of this program, are the ones who can spot the difference between the manganese brass slug and a solid ounce of 24-karat gold. You understand that golden is not the same as gold. This distinction is why the battle for $50 silver is so important. It is not just a number on a screen. It is the market waking up to the scarcity of the real thing. The paper markets, the COMEX, the LBMA, they trade hundreds of ounces of paper silver for every single physical ounce that actually exists in the vaults. That system works fine as long as nobody asks for delivery. But as we see industrial demand ramping up for solar panels, for electronics, and for military applications, the physical inventory is draining. We are approaching a tipping point where the paper leverage breaks. When that happens, $50 will look like the bargain of the century. The inventory data mentioned in the manufacturing report is another piece of this puzzle. If manufacturers are slowing down production, it means less silver will be consumed industrially in the short term. The bears will use this as an argument to short the metal. Recession is coming, industrial demand will crash, they will say. But they are missing the monetary demand. In a recession, when the Fed cuts rates to 0 and restarts QE, investment demand for silver explodes. The loss of industrial demand is a drop in the bucket compared to the tsunami of monetary demand that enters the market when trust in the dollar evaporates. Let's look at the calendar ahead. We are moving into December. The tax law selling season is upon us, which usually creates headwinds for commodities. Yet here we are with silver at 50 and gold over 4,000. The seasonal weakness is being overpowered by the macro urgency. The market is looking ahead to 2025, seeing a government that is $35 trillion in debt, seeing a social security system that is insolvent, and seeing a geopolitical landscape that is fracturing. The old rules of seasonality do not apply when the system itself is under existential threat. The update on the Fed Watch tool is something you need to monitor daily. That jump to 69.5% for a rate cut is not just a number. It is the bond market bullies forcing the Fed's hand. Jerome Powell wants to talk tough. He wants to be Paul Volcker. But the market knows he is Arthur Burns. The market knows that at the first sign of trouble, the printers go BRRR. That is why the dip in gold was bought so aggressively. The smart money knows that the higher for longer narrative is dead. We are now entering the inflate or die phase of the sovereign debt bubble. I want you to consider the psychology of the Friday turnaround. In a bear market, rallies are sold. In a bull market, dips are bought. Today was a classic by the dip scenario. The fact that we didn't close at the lows, despite the heavy selling pressure, indicates that the path of least resistance is higher. The shorts are exhausted. Every time they slam the price, they are finding fewer and fewer sellers. The weak hands have already left the building. The only people left holding silver now are the diamond hands, the people who understand the fundamentals and aren't scared by a $1 drop. We also need to address the impact of the broader equity markets on precious metals. The S&P 500 is trading at valuations that make the dot-com bubble look rational. When that bubble bursts, and it is a mathematical certainty, there will be a rush for liquidity. In the initial panic, gold and silver might get sold off as margin calls hit. We saw this in 2008 and 2020. But today's price action suggests that we might be decoupling from that correlation. Gold is increasingly being viewed as the hedge against the stock market, rather than a risk asset that moves with it. If stocks crash and gold rallies, that is the endgame signal. The summit metals of the world, the dealers and the refineries, are seeing this demand firsthand. While the paper price fluctuates, the premiums on physical coins and bars remain robust. You cannot fake physical demand. You can print paper contracts on the COMEX until your fingers bleed, but you cannot print a silver eagle. You cannot print a gold buffalo. The disconnect between the spot price and the physical price is the spread that represents the risk of the entire system collapsing. As an investor, you want to be on the right side of that spread. So what is the forecast for next week? All eyes will be on that December 10th Fed meeting. The data coming out between now and then will be scrutinized for any excuse to cut rates. If we see more weakness in the labor market, or if that manufacturing inventory bloat translates into layoffs, the odds of a cut will go to 100%. And if the Fed cuts rates while silver is sitting at $50, we are going to see a gap up that will leave the shorts decimated. We are looking at a potential explosive move to $60 or $70 in very short order once that $50 resistance turns into support. But let's not get complacent. The manipulators are still in the game. Oh, Mr. Slammy will be back. They will try to paint the charts bearish. They will try to trigger your stop losses. This is psychological warfare. They know that if silver breaks free, it exposes the devaluation of the dollar for all to see. A soaring gold and silver price is a report card on the government, and right now, the government is failing. They will fight to suppress the price to maintain the illusion of stability. But they are fighting gravity. You cannot suppress the price of a finite asset forever while expanding the supply of the currency used to measure it. The golden dollar anecdote I shared earlier really sticks with me. It reminds me of the Roman Empire in its final days. They started clipping coins, mixing copper with silver, debasing the currency to pay for wars and welfare. The people who held onto the old, pure silver denarius survived the collapse. The people who trusted the new, debased coinage lost everything. That proof Sacagawea dollar is our modern debased coin. It is a token of a dying empire. It has no intrinsic value. It only has the value that the government decrees. Gold and silver require no decree. They are value. As we head into the weekend, I want you to look at your portfolio and ask yourself a serious question. How much of your wealth is in golden manganese brass, paper stocks, bonds, fiat cash, and how much is in real tangible value? The volatility we saw today is a warning shot. It is a tremor before the earthquake. The system is unstable. The debt is unpayable. The inflation is structural. The only way out is a revaluation of gold and silver to levels that seem impossible today, but will seem obvious in hindsight. Do not let the daily fluctuations shake you out. If silver drops $1, you buy more. If gold drops $20, you back up the truck. The trend is undeniable. The world is moving away from the dollar standard and back to a hard asset standard. The central banks are doing it. The BRICS nations are doing it. The only people not doing it are the average Americans watching CNBC. Don't be the average Americans. Be the insider. Be the contrarian. In conclusion, today was a victory for the bulls. We took the best punch the cartel could throw, and we are still standing. Silver is fighting for 50. Gold is holding 4,000. The Fed is cornered and about to cut rates into inflation. The stage is set for the greatest transfer of wealth in human history. Make sure you are on the receiving end of that transfer. Keep your powder dry, keep your head on a swivel, and most importantly, keep stacking physical metal. This is a marathon, not a sprint, but the finish line is getting closer every day. Have a great weekend, stay skeptical, and hold onto your gold and silver with diamond fists.